Hello and welcome to Charting Points, a technical look at ag markets. My name is Brian Como. I am FBN's market analyst. Today is September the 5th, 2023. Normally this comes out a little bit sooner than we'd like to, sooner than it is today. We did want to wait for the crop condition ratings that are out today to talk about those due to the holiday yesterday. The USDA delayed the release of those crop condition ratings. I think they're going to be important, so we're going to talk about them right away. But first, I want to get a disclaimer out of the way. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute or for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties expressed or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Past results, of course, are not necessarily indicative of future values. All right, today, let's start with the soybean condition index. Today we saw the USDA shave 4% or 5 percentage points off of this, 1 from the excellent and 4 from the good category. They added 2 to the poor and 2 to the fair as well. So we are seeing degrading crop condition ratings in this week's report. I know that some of the cuts were likely priced into the market already. I don't know if 5 was, I think based on last week where they only reported 1% good to excellent change, the market may have readjusted itself. As a result, I think that 5 is heavier than what the market was expecting. We may see a bullish response as a result of this. I don't know if that'll carry through in the long term, but it will at least start to generate some yield estimates for the USDA, which I think is on the 12th of Tuesday, September the 12th. So that would be next week, Tuesday, is when the USDA makes their next guess on soybean condition rating. So we would have one more condition rating released before we get that report, that USDA crop production report, and the WASDE next week. So this may be the big reset. I think we probably should see a positive response in the markets as a result of this. Corn may be a different story. There was 3% that was shaved off. It may get some follow through from beans. I think beans will be the one that is most heavily traded on this data. I feel like a 3% reduction in corn was likely priced in. We may not get the same level of bullish response from the corn, if anything at all, on the corn. So just to be aware of that, although conditions are starting to slip into some, below some kind of 5-year ranges at this point in time. So overall, maybe, the lower tide on ratings will raise all boats on the pricing side. Corn may get swept up in that. But for sure, but it's a little bit less certain on corn, or I would be less certain on corn, and I'm not 100% certain on beans either, but I think that there's a bigger probability that we will see a positive uptake on beans. Here's the bean chart. Here's a couple of things that we might want to watch here. So first of all, let's get a pen here. First of all, we saw kind of oops. Did I select my pen here properly? Maybe not. We did see a bit of a support break here. This is a minor support line, so I wouldn't necessarily put too much weight on it, but there is some moving averages here and a trend line here that might be a bit more major. As you can see, that's currently tracking around, call it 1350 would be here. So if we started to break down below that, I'd start to get bearish. But right now, this does look like a pullback in an otherwise stable, I'm going to use the word stable market. I think that this high is going to be important now, although that is at 1409 is where this high would be. We got 1435 up here as well. I don't think that the trade will bring a bullish trade would bring it back up to break this support. So we might be in neutral territory here. You can see that the 20-day and the 50-day are converging. The 200-day is not that far off. The 100-day is coming up. This looks to me more like a neutral market overall, but we probably will see a bit of a bounce into tomorrow's session as a result of these crop condition ratings. We've been calling this crop neutral bullish, but these markets are more on the neutral side. I think my bullish stance is just because we haven't necessarily broken down below some support level yet. So if it did kind of break down into that 1340 area, that might be give us some cause to go to a straight neutral, which would allow for, neutral trade back into the 1280 area. I still wouldn't even consider beans bullish or bearish if it got down into that 1280. That's the scary thing, is there's a significant amount that you could lose here without actually getting into full-on bearish territory. As a result, the risk is a little bit skewed more towards the risk side than the reward side at this point in time. But we may see beans push back up towards $14 tomorrow if the market didn't expect this 5% cut. Here's the corn. As you can see, we are looking a little bit more neutral here as well as we continue to kind of trade down near these areas of support and bounce. It has tried to kind of breach the 20-day a number of times, but kind of failed to do so in the last little while. One kind of feather in corn's cap here is that we did see speculators or managed money reduce their short in corn as a result of some of the heat and dryness as we went forward. We saw some buying activity last week. So where we were in the six-figure short contract area last week, that they did, as of Tuesday anyway of last week, move that position back to about 87,000 contract short. So a very small reduction in the short position. But we also saw a rise in beans here as well. Beans are long. They extended the length a little bit. As you can see, it's not outside of any normal parameters or anything like that. But we did see some buying interest last week, which means that some of the crop condition ratings reductions are priced into the market. It's just how much of those reductions are priced into the market. That's the big question for tomorrow morning or later on this evening even. All right, we're going to touch on canola a little bit of a concerning trade in canola today. We saw this kind of consolidation period that kind of took over the last week or so. And it would have been interesting to see if this push to the upside on a break of this kind of very small consolidation range, but instead it breached to the downside. Now, this isn't the only market that is showing some weakness in the vegetable oils today. We did see Euronext rapeseed also move lower today by a considerable amount and kind of break below some of the very short-term kind of channel trade that it was doing. Of course, there is some support on Euronext at these two levels here. We did see bean oil also kind of trade lower, although it's kind of more trading in a bit of a pennant formation here. As you can see, again, neutral. All these vegetable oils are relatively neutral, actually. But one thing that I did want to point out, now I just kind of layered canola and rapeseed together on the chart because I was interested to see which one turned first, right? Which is the driver of this market. And as you can see, the orange here is canola. I didn't label them, but the orange here is canola. The purple is Euronext rapeseed. And as you can see, where I put the crosshairs here was kind of the high of the day before we started to see the market fall off. And you can see that canola led this move. So what that tells me is that we probably are seeing some harvest pressure in Canada. Even some of the anecdotal yields this morning that I heard when talking with our advisors were a little bit surprising to me. I've kind of been on the side of the market that would suggest that yields are going to disappoint when farmers go in with the combines. I know there are some that are disappointing, but they are balancing themselves out with some surprises to the upside. So I'm hearing a lot of amalgamated average in the last couple of days. Now that's just very early stuff. And again, it's anecdotal, not scientific. But I do think that if we continue to see the market turn lower, that could mean a bit of a combination of harvest pressure. And it could maybe mean too that there is some positivity or some surprises to the upsides on yield that's happening, which would be a bit of a bearish signal. So we want to stay close to this market. I'm going to go back here to the canola. It is kind of hugged and bounced off the 20-day moving average today. We got the 50-day moving average coming up here as well. So there is some support here in this market. Obviously, we have this low, but what I do want to kind of illustrate here is, this low down here is just above 750, between 750 and 760. I want to reiterate that if you are in a position where a move down to that level would hurt, I would advise that you want to take some of that risk off the table. Now, our official recommendation is to be at 50% hedged for this season. That doesn't mean you have to be 50% sold with no upside. You could be using over-the-counter contracts or something that allow you to continue to take upside without taking downside risk. Those would be the best types of contracts to use. Or if you're okay being just getting potential gains in the future on the last 50% of your crop, then nothing to worry about. But I would be very cautious right now of entering this harvest season with more than 50% of your risk to the downside not covered. So just wanted to throw that out there. Just kind of wanted to touch a little bit as well on November seasonal patterns. Here we are about in this territory here. My red pen isn't showing up very well on this. This is November canola seasonal. As you can see, as we move towards the end of September, that tends to be where we see some of the bottoms of this market. So as a result, we could continue to see some seasonal weakness in canola before it bounces. So again, if you don't want to stomach some of those losses before we start to see a potential bounce because of seasonality, again, that's not guaranteed, but if that risk is going to hurt, if it goes down to that level, I would advise to take some risk off the table. That doesn't mean you need to limit your upside on those bushels, but just make sure that you're in a comfortable position to weather that kind of seasonal pattern. All right, moving into wheat. Wheat from the charting standpoint here looks still very bearish, right? All of these moving averages are turning lower and continuing to move lower. The 20-day is actually diverging from the other markets. We've seen a 50-day, 100-day cross now, which is bearish. Again, lots of the wheat markets are looking very, very similar. This is Minneapolis, broke late last week to a new low and continues to push lower today. This is, again, not unseasonable at this point in time. We are getting to the point, where this is Minneapolis historical patterns, by the way. We are getting to the point where, the second or third week of September is when we generally see lows. As you can see, this is significantly more correlated year by year than the canola one is. So a little bit more confidence maybe on the wheat seasonals than we would be on some of the others. But this is what we're looking for. This bounce in October, which generally comes in October to early November, is going to be important because I should have included it, but the July seasonal patterns do not show the same kind of pattern. They show the July seasonals. So if we're looking forward after the December contract expires, this is the high of the March, May, and July seasonal charts. So this rally that occurs after harvest here, if there is one that's going to happen, is going to be a very important one to take advantage of. Did want to talk a little bit about spread as well between Minneapolis and Chicago. Now, there isn't a huge spread between Kansas and Minneapolis. The world isn't really short of protein from a protein standpoint, but there is a spread right now between the Minneapolis and the Chicago, which is relatively high, or at least it feels high at 166. This is on the front month contract right now. It depends on how you look at it. If this is the range that we're looking at from protein spreads, then we're maybe mid to lower end of that range. But as you can see over the last 10 years or so, or maybe this is 5 years, Q4 of 2018, we spent a considerable amount of time at lower spreads than this from the mini to the Chicago. We aren't really short of protein in the world, and I do feel like as we get Chicago south of $6, that the risk, if the market is going to continue to be bearish, is maybe heavily weighted more towards the Minneapolis than the Chicago, as I feel like when there's a 5 in front of the Chicago number, that looks cheap, but when there is a 7 in front of the Minneapolis number, or even as we get close to 8, it may seem a little bit more expensive relative to. So we may see that spread come in a little bit from the Minneapolis to the Chicago. All right, one thing I also wanted to touch a little bit, I touched on it this morning in the audio broadcast as well, but just the macro risks that exist out there. Here is the US dollar just before we started creating this video here. US dollar index rose to 104.82 this morning. It's been pretty constant all day there, but it has risen to new highs on the day as a result. here's something interesting too, is when we look at this is kind of a signal or a barometer that the market is looking at a risk off situation. And that doesn't necessarily mean ag commodities specifically, but just more of a broad sense, particularly the stock markets and things like that, which can weigh on all commodities to some degree. But just to kind of prove why this is happening is, here's the US 2-year bond yield. Now on Friday, it actually hit a new low, but bounced back very quickly after that. Then we saw a rise. We're at about 4.95 right now. This would be percent yield on a 2-year bond. But what's interesting is when you look at the 10-year, the last 2 days have actually seen some very significant jumps, almost bringing it back within, a tenth of a percentage point to the highs, which means that the market has kind of shifted from believing that there were going to be a more neutral stance to interest rate hikes to maybe a more hawkish or more hawkish tone to the market, where the market might be starting to price in rising interest rates again, or at least heavier cost of borrowing. So that's a bit of a concern, I think, overall. It's a pretty big turnaround on the US 10-year note here, particularly given the shifts that are happening. And I mean, we're seeing shifts all over the map on a pretty regular basis, and obviously very data dependent when it comes to inflation numbers and growth and things like that. All right, that is all we had for you today. Thank you for joining us. We will see you again. We'll see you again on Thursday of this week. Thank you very much.